Hey y'all, Andrew here with 5 Points Financial Planning. We've been getting a few questions recently about whether it makes more sense to contribute to an IRA or a Roth IRA. And this may have to do with, individuals are receiving their stimulus checks, and fortunately haven't been too financially impacted by COVID-19. And with the tax date being pushed back from April 15th to July 15th, they might be looking to either make contributions for 2019 or supplement. Maybe they made some contribution, but they want to go back and maximize. And even if you've filed for 2019, you can still amend that return to make these contributions. And particularly which one makes most sense for your situation, whether an IRA or Roth IRA. Most times, even though it may be a hassle to amend, it could be very financially beneficial to go ahead and make those additional contributions for 2019. But before we get into that, let's just discuss a little bit about how each of these accounts work. So with an IRA, when you make a contribution to a deductible IRA, you put the funds in, but you don't pay, you get the tax deduction today. So you're not paying the tax, you get a tax deduction today for the contribution that you make. And once that is made, the funds in the account continue to grow tax deferred, meaning you don't pay any taxes on the interest or in the earnings within the account. Once you do withdraw the funds from that account, however, though, it is fully taxed as ordinary income. So, and that includes both the contributions and the earnings within the account. The full distribution is going to be taxed as ordinary income. There are also, there are a lot of stipulations associated with this, but generally, if you withdraw after age 59 and a half, there's no penalty associated with that. Once you reach age 72, based on the new Secure Act that was passed, the government then requires you to start taking out a certain amount. And this amount is going to be based on a factor which is associated with your life expectancy. With a Roth IRA, it acts pretty much in the opposite. So with the Roth IRA, you make the contribution, you're paying the tax today. So whatever marginal rate or marginal tax bracket you're in today, that's where you're paying the tax on the contribution. But the money continues to grow tax-free, meaning you're not being taxed on any interest or earnings. And when you withdraw funds from that account, they're all tax-free as well. Again, the same 59 and a half general guideline. If you withdraw after age 59 and a half, there's no penalty associated with it. There is no age limitation or restriction. So like the IRA at 72, where the government requires you to start taking some money out, there is no required distribution associated with the Roth IRA. So that money can continue to grow really throughout your life expectancy and then pass on to your heirs tax-free as well. With a Roth IRA, it also offers a little more flexibility in that because you're paying the tax up front today, you can withdraw the contributions at any time without sort of penalty or tax. So let's say, for example, you contribute $6,000 a year for 10 years. And over those 10 years, you've also had earnings in the account. So the account is now worth $100,000, $60,000 of which is contributions, $40,000 of which is earnings. You can withdraw that $60,000 without any sort of penalty or tax associated with that because you've already paid the tax on that amount. And so there's a little more flexibility associated with the Roth IRA, but they both can make, they both have their own place, and for the right individual, right or situation, they might make most sense for you. So there are three things that you need to consider whether or not you're even eligible for either of these accounts. The first one is you need to have earned income. If you don't have earned income from wages, salaries, or tips, or business income, you can't contribute to a Roth IRA or an IRA. So you need to have earned income. The second one is there are AGI limitations and thresholds, and you can find these on the IRS website. But for the Roth IRA, thresholds are going to be a little higher than for a deductible IRA. For a deductible IRA, there's two different sets of AGI thresholds, and it's whether or not you, or if you're married, your spouse, have access to a retirement plan through your employer or not. So if you do not have access, or your spouse does not have access to a retirement plan through your employer, the AGI thresholds are going to be a little higher. If you or your spouse both have access to retirement plans, your AGI threshold is going to be a little lower. But again, those numbers, they do adjust on an annual basis, but just be sure to check the IRS website to see which one you're eligible for. And then the IRA used to have an age limitation, but that got wiped out with the Secure Act as well. So you used not to be able to contribute past age 70 and a half, but that is no longer the case. So as long as you have earned income and you fall under those AGI thresholds, you could be eligible for both of those accounts. But determine which one is the best fit is impossible to know, because we need to know two pieces of information. The first one is going to be, what are the tax rates going to be in the future? And then the second one is going to be, what tax rate or what tax bracket are you going to fall in retirement or when you withdraw from the account? And again, those are just things we don't know. We can certainly speculate. We can speculate that tax rates are going to go higher or lower, or we can say, in retirement, I'm not going to have as much income, so my the marginal rate, the marginal bracket that I'm in is going to be lower. And again, we can guess, but we just don't know for sure. And so, as an example, let's say that you assume or you guess that you're going to be in a higher tax bracket in retirement or when you take those funds out. If that's the case, then a Roth IRA makes most sense today, because you're going to pay the tax today in a lower bracket, but when you withdraw the funds, you're going to be in a higher bracket, and that money is going to come out tax-free. So it makes more sense to pay that tax today. Conversely, if you know that, or you speculate that you're going to be in a lower rate or lower tax bracket in retirement, then it makes more sense to deduct and not pay the tax today while you're in a higher bracket, and instead take out those funds that are taxed as ordinary income when you're in a lower bracket in retirement. So with that, because we don't know, it really does depend a lot on obviously individual circumstances. But what we typically recommend is to, particularly, especially if you have access to a retirement plan through your employer, is to contribute up to receiving the full match if your employer offers a match. So for example, a lot of employers, if you contribute 4%, they might match up to 4%. So that should be the where you initially allocate your first funds, is to contribute to your retirement plan to get the full match. And then we like to skew toward the Roth IRA just because of the flexibility associated with it. So contribute to the maximum to the Roth IRA, and then if you still have additional funds, go back and contribute more to your 401k. Again, you are not going to receive that employer match, but you're still going to put more in and get a little tax deferral from that. If you're in a very high tax bracket today, then that might be a little different. But typically, if you're going to be in a very high tax bracket, you're not going to be eligible for some of the Roth IRA or the deductible IRA options anyway. So that's just why we typically recommend that. But again, everybody's a little different. But hopefully this gave y'all a little food for thought on which one makes most sense given your situation. Hope you learned a little something. If you have any questions, please let us know. Thanks for watching this video, and I hope you guys stay safe.